There is a very particular kind of fear, a feeling only those who have stepped into the world of investing truly understand. It's not the fear of ghosts in the dark or of heights when standing atop a skyscraper. It's the fear of opening your investing app and seeing a blazing, fiery red stretching from the top to the bottom of your portfolio. Your heart sinks, your breath catches. One simple haunting question repeats in your head. What do I do now? In that moment, the line between a steadfast investor and a panicked individual is paper thin. For beginners, this market downturn phase is the most brutal real-world test where all the beautiful theories about long-term investing can shatter overnight. Today, we won't talk about why the market is down or predict when it will recover. We're going straight into the darkest room in a new investor's mind when the market plunges. The place that holds the instinctive reactions, the mistakes that seem logical in a moment of confusion, but are actually the most costly traps. I'll show you the 3 biggest mistakes, not 3 theories, but 3 specific actions most beginners take when they see red. And more importantly, we'll build a simple set of tools so you can not only weather this storm, but emerge from it stronger and wiser. The first mistake, and perhaps the most common, selling in a panic to feel safe. Let's revisit that initial emotion, fear. Our primitive brain is wired to respond to threats in 2 ways, fight or flight. When the market falls, the brain doesn't see a chance to buy at a discount. It sees a predator attacking your money. And the most natural reaction is to flee, that is to sell everything to get out, to make the threat disappear. The immediate relief you feel after selling is real. You've locked in the loss, and you no longer have to endure the psychological torture of watching your money evaporate daily. But this is the perfect trap. You are trading a potential paper loss. You haven't really lost it if you don't sell, for a permanent realized loss. You've turned short-term volatility into permanent failure. Remember the classic saying, the stock market is a device for transferring money from the impatient to the patient. The person selling in panic is transferring their money and their cheap shares to those calm enough to buy. The solution isn't don't be afraid, but to prepare for the fear. Right now, write down a sentence and stick it on your computer monitor. My goal is not to feel safe every day. My goal is to build wealth over the next 10, 20 years. And when panic strikes, close the app, stop looking at it, go for a walk, exercise, do anything to avoid making a decision in a heightened emotional state. The first action when the market drops should never be hitting the sell button. The second mistake, more subtle and equally dangerous, stopping your regular investments and hoarding cash waiting for the bottom. After resisting the urge to sell, many people think they've become clever. They say, I won't sell, but I won't buy more right now. It's too risky. I'll wait until everything stabilizes. When the market hits the bottom and starts to recover, then I'll jump in. Sounds very reasonable, right? But this is a massive illusion. No one, not even the most seasoned experts, can pinpoint exactly where the bottom is. Stopping your automatic investment plan means you're trying to time the market, an impossible game. Imagine you're shopping at a grocery store. Last week, your favorite brand of milk was $5. Today, it's on sale for $3.50. What do? Would you say, oh, the price dropped, that's dangerous, I won't buy it. I'll wait until the sale is over and it goes back to $5 to buy it later. That sounds crazy, doesn't it? But in investing, we act like that every day. A market downturn is a sale for long-term investors. Stopping your buys now is like refusing to buy things on discount. The solution here is brilliantly simple and mechanical. Automate your emotions away. Set up an automatic transfer and purchase every single month, regardless of whether the market is green or red. Once it's automated, you no longer have the mental battle of should I risk buying now. The machine does it for you, and you get a wonderful feeling. When the market is down, that automatic purchase buys more shares for the same amount of money. This is the secret superpower of dollar cost averaging, DCA, turning the market's fear into your accumulating advantage. The third mistake is the mistake of subjectivity, taking advantage of the dip to jump into high-risk assets, hoping to make it back. This is the stage after you've overcome the first 2 temptations. You didn't sell, you're still investing regularly, but a thought starts to smolder inside. The market is down this much. Maybe I should look for some small, riskier stocks or crypto. If they bounce back, I could make multiples, maybe even recoup all the losses in my main portfolio. How dangerous is this thought? It's like you've just survived a storm at sea, your ship is battered, but instead of finding a safe way to shore, you decide to jump into a smaller rowboat hoping it will get you to treasure faster. You're stuck in gambling to break even psychology. When your main portfolio is in the red, the psychological pressure is immense. You want a quick fix, a miracle. And penny stocks, obscure cryptocurrencies, or leveraged contracts suddenly become strangely attractive. This is when you are most vulnerable and can lose what's left of your money. The solution to this mistake is discipline and loyalty to your original plan. Clearly distinguish between investing and gambling. Investing is buying a piece of a good business at a reasonable price and waiting patiently. Gambling is betting on the short-term volatility of a price. When the market is down, be loyal to your pre-researched list of quality companies or index funds. If you want to buy more of the core, reliable assets already in your portfolio. Don't go hunting for a unicorn in an unfamiliar place. Write down your investment criteria and swear to yourself you will never break them, especially when times are tough. So, what does all this add up to? It creates a posture of readiness. A market downturn is not a disaster to be avoided. It is an inevitable part, a season in the investing year, just like winter. Trees shed their leaves to store energy for a spring bloom. Great investors aren't made during the cheerful days of a bull market. They are forged, tested, and defined precisely in these crises, these gloomy days. The three mistakes above are the major pitfalls on that path. But each pitfall comes with a shield. The anti-panic shield. Turn off the screen and remind yourself of the long-term goal. The anti-hesitation shield. Automate your purchases. The anti-recklessness shield. Stay loyal to your predefined plan and criteria. Next time you see red, instead of asking, "What should I do now?" smile and tell yourself, "The shopping season has arrived." Check if your automatic investment has run, review your wish list of quality businesses you want to own, and then go live your life. Because true wealth is built by calm decisions made in the storm, not by fearful reflexes. You now have the map to avoid getting lost. It's time to walk the path. Ready to turn market fear into your advantage. Hit that like button if this reframe was helpful, and subscribe for more straightforward strategies to build your investing confidence. What's the one mental rule you'll set for yourself before the next market dip? Let me know in the comments below.